This is a demonstration of the CML Viz Trade Machine Custom Earnings Handling, and it is one of the most powerful long-term option winning strategies you'll probably ever find. We enter our ticker, we look to buy a straddle, but we want to handle earnings in a custom way. We click the custom button. What we want to do is buy the straddle 6 days before earnings and then close the straddle on the day of earnings, which is 0 days before earnings. For companies that have earnings that are released before the market opens, you would want to put a 1 here. For companies like Google, where they report after the bell, you put a 0. We'll focus on the 50 delta, and here you can see an 89% return. Since we're only trading for 6 days, and we're looking at 12 earnings announcements, it's a total of 72 trading days in which the strategy returned 89%. Or annualized, we're looking at something close to 450%. This also works over 2 years. In this case, we're looking at 8 earnings releases, 6 days each of trading. That's 48 trading days and a 57% return. Again, over 400% annualized returns. And here's what's happening. While the implied volatility ebbs and flows, it always rises into earnings, which are denoted in the chart here with ease, and we've circled them in yellow. This is Google's 30-day rolling implied volatility chart. The question every option trader, whether professional or amateur, has long asked is if there is a way to profit from this known volatility rise, these spikes. And it turns out, over the long run, for stocks with certain tendencies, the answer is actually yes. And here's what's actually happening. If we look back from July 10th through July 16th in 2015, so our first earnings period in this 2-year backtest, we can see that we would have entered the long straddle on July 10th, and we would have closed it here on July 16th. But the stock in that period rose in anticipation of earnings. That straddle was purchased for $29.20 and was sold at $35.40, which was a 21% gain. But we did not take the earnings risk. Of course, if the stock had declined, that would have been an equally big winner. But the real moment of clarity here is to understand that if the stock did nothing, the straddle was about break even. And here's an example of that. If we fast forward 1 year to the earnings release on July 27th, 2016, we would have entered our strategy on July 22nd, and the stock was essentially flat. The straddle in this time period was opened for $41.70 and closed for just $41.75. In other words, the trade was a wash. But what's happening is we are gaining a few days to potentially have a stock move with muted risk. Over time, having this low risk 5-day option turned into a monster winner. That's it. This is how people profit from the option market. It's preparation, not luck. Thank you for watching our demonstration of our custom earnings handling.